Hello, investors. Thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today, I want to talk about Global Payments. Global Payments is a payments technology company. When I first looked at it, I was kind of very excited about it, because fintech is particularly hot right now. And on the surface, this looked really cheap because it was only being priced at approximately 18 times adjusted EPS. So, there was a lot here to be kind of compelled towards it. And I kind of started digging in. And the more I looked, I kind of like, okay, this doesn't really make a lot of sense to me. So I'm gonna go through all that. Okay, so anyone that's kind of been invested in a stock is down approximately, let's say, 20% or so in the past year. That's normally quite an interesting setup, right? So you got a lot of people that kind of despondent with this, and they kind of just want to get rid of this position because it's been a loss for them, and they just want to start 2012 afresh. So with that in mind, it's a good setup generally. You got a business that kind of looks like it's growing, stock is down. That's kind of like normally a good setup for value investors, right? So as as I look through this, right? So Q4 21, they've raised their guidance several times throughout. Basically, every single quarter they've been raising their guidance so that Q4 21 is ultimately going to be up 14% year over year versus the same period a year ago. Now, keep in mind that the business reports adjusted revenues, but I kind of just focused on the GAAP revenues here for our purposes. I think that works. So we're looking at a business that is kind of growing in the mid-teens. Okay, so seems okay, right? You got a business that's growing in the mid-teens. It's facing payment solutions, so it's kind of like, okay, yeah, that looks kind of interesting, right? Now, when I think about this, right, I looked at this and I was like, okay, oh, look, the EPS number is going to be up approximately 28% year over year. That's, driven through some buybacks. I was like, okay, that's, there's a lot here that's going to be worthwhile taking a position here. Now, as we go through this, I started unpicking this and I said, look, okay, so in the past 9 months, the total amount of free cash flow is approximately 1.7 billion. And in the interim, they've actually spent about 1.8 billion buying back stock. And I'm starting to think myself, okay, so they've bought back more stock than they actually made in free cash flow. So I'm like, okay, that's kind of interesting. And the amount of stock buybacks in the past 9 months is actually 3 times more than they've repurchased during the whole of 2020. So during 2020, they repurchased approximately 630 million worth of stock, but in the 9 months, they've actually repurchased 3 times more than that at 1.8 billion. So the bulk of the repurchases have actually been made at prices higher than the stock trades right now. So I'm kind of like, probably not that great when it comes to capital allocation. And when I think about it, so anyone who's kind of any of those repurchases that has been taking place over the, let's say, last 6 months, the last 12 months, or the last 18 months have been made at share prices higher than the stock trades right now. Then I kind of looked at the number of shares outstanding, and you can see. So if I look back to Q3 of last year, the number of shares outstanding was 300 million, and the number of shares outstanding at the end of Q3 21 is 293 million. So it's basically they've repurchased only about 3% of the total shares outstanding. So even though they deployed 1.8 billion worth of capital, it actually hasn't really nudged the needle that much. And if I go back further and I look back starting in the back end Q4 2019, so 2 years, it's still approximately 3% of the stock that they've repurchased. So all that capital they've actually sent to repurchase share, not only has it been done at higher prices than the share prices right now, they've actually not actually moved the needle that much on the number of shares outstanding. So I'm kind of starting to think, okay, probably not that great, Now, all this has to be taken into context because you have to think about what the next year is going to bring. The market's always looking ahead, and you have to think about, can this business grow at 15% compounded over the next year as it has done as it comes to exit 2021? Now, keep this in mind, right? So if I look back to 2018, the amount of stock-based compensation was approximately 58 million. Okay, so in 2018, stock-based compensation was 58 million. Meanwhile, as we look to exit 2021, the amount of stock-based compensation is approximately 200 million. So the amount of stock-based compensation over the past 3 years is up over the past 4 years is up approximately 4 times, while any shareholder is only, if we include the dividends, is only up approximately 35 to 40%. So there seems to be quite a large discrepancy between what the shareholders made, which is about 35 to 40%, versus what management as a whole has made, which is, the team as a whole is up 4 times the stock-based compensation. So I'm like, okay, it seems to be the case that, they're kind of getting quite rich as a team, but, the shareholder probably isn't going to be that well set up. Now, when I think about this, right, if you have a business that's priced at 18 times EPS and it's growing at 15%, that's kind of quite reasonable. But then I start looking at it, and it has a net debt position of 7 billion. So it's a business that if you were to hold on until 2025, which is a long period of time to be, with a strong conviction here, the free cash flow would hit around 4 billion. But, when I look through, the way that they account for free cash flow is that they make a lot of acquisitions, and those acquisitions boast the next year's free cash flow, and it makes it look like it's actually growing. But all it's doing is that free cash flow is taken to buy new companies. And if you already have a balance sheet with net 7 billion on net debt, you're kind of like, okay, that's going to be quite restrictive in what you're going to be able to buy that's actually going to move the needle to any meaningful extent here. So it's kind of like, it looks really, really attractive and looks really, really cheap. But when I kind of start thinking about like the share buybacks, the amount of stock-based compensation increasing so much, the highly leveraged balance sheet, I'm starting to have niggling questions about whether they can or not be growing with conviction over the next year at 15%. I'm like, okay, the risk reward doesn't seem that favorable to me personally. But if you want to find out investments that I find that have a great risk reward right now, don't forget to check our marketplace. It's called Deep Value Returns. And you can check out and see what other people have said, read the reviews, get familiar with that. And yeah, hope to see you soon. Bye.